Last but not least, we have Jonathan Kennedy, who is a senior vice president at AgWest Farm Credit in Tulare, California, where he is portfolio manager overseeing a team of lenders who work primarily with dairy and other diverse crop farmers in the San Joaquin Valley. With nearly 36 years in agricultural finance, he brings a producer-informed lens to how methane mitigation, sustainability practices, and evolving regulations shape credit risk, investment opportunities, and farm-level decision-making. Join me in welcoming Jonathan Kennedy.
All right, good morning. My name is Jonathan Kennedy, as he announced. I didn't get a chance to put a slide deck together due to travel and things, and I probably couldn't compete with all the slide decks that I saw yesterday with all the fancy graphs and all that. But I do have a few notes to kind of go by as far as my experience in the methane digester industry as far as financing that. So it's a pleasure to be here with such a high caliber group of PhDs and scientists. And I'm honored to be here today to represent AgWest Farm Credit and the farm credit system. And I'm not sure whose idea it was to invite bankers to this group, but hopefully we had some perspective. I've been a lender at the field level, so I'm basically a loan officer with some management duties for the past 36 years, in the southern San Joaquin Valley, located out of Tulare, which is about 200 miles south of here. With us being a cooperative lender, which was kind of discussed by others, my view of sustainability is that, I need to loan money to those in need that meet our mission to serve, agriculture and rural America, but I also need to recoup that money via repayment from operations so that I can recycle those funds back to the next in need. As a lender working on thin margins, we can't afford to lose or write off very many loans to stay in business to provide capital to rural America. My focus the past 15 years has been lending to the dairy industry out of our Tulare location. And Tulare County, for those who don't know, is the #1 dairy county in California, and we have about 490,000 cows in Tulare County. How did I get here? I'm not sure. I'm just a loan officer versus a high-level guy. But Joe Proudman of UC Davis reached out to a contact he had with CoBank, and which is AgWest lender. The manure started flowing downhill, sort of say, from CoBank down the chain through AgWest, and my name came up as someone that discussed financing for methane emission reduction through my work as a lead lender in the financing of some dairy digester construction projects that I originated between 2019 and 2022. This is a new and something that had never been done before in terms of financing digesters to produce RNG for transportation fuel and unique to the farm credit system. Through that, I was able to get CoBank and 8 additional associations, in the farm credit system to participate in lending to 6 clusters that's composed of 47 individual dairy digesters, which amounted to about $172 million in financing, construction and term financing. Farm Credit West, which was the previous association to AgWest Farm Credit, was the lead lender, and I was kind of the lead loan officer and kind of a one-man band kind of running that project. The purpose of the projects was to capture methane and produce and market RNG for California transportation market. All the projects are located in Kern, Tulare, and Kings County in the southern San Joaquin Valley in AgWest charter territory. So how did I go from dairy lender to renewable fuel? It was back in the fall of 18, I was approached by one of my progressive dairymen who had developed some power purchase agreement digesters and had a history in that field and with the LCFS credits. I was also a part owner in a dairy digester development company. They had a project together which is kind of unique that got us on board. That was partly farmer owned, some private capital. The debt was about 42% of the total project, and equity consisted 58%. A good chunk of that, CDFA 16% roughly of the projects, 78 million. Other California governmental incentive grants for renewable energy and infrastructure matching grants. There was roughly about 18% from that. Then owner equity, there's about 24%, and a lot of that was the dairy investor group kind of invested a whole bunch of money, as well as a major oil company put in, but the predominantly source was a dairy-owned capital that wanted to invest in the future. You know, at the time, very good margin and break even compared to commodity price. Why did we take it on? Our purpose and mission is to serve rural America and agricultural producers. The projects would help the dairy industry to work toward achieving the 40% reduction in methane emissions from the 2013 baseline by 2030. This is going to help preserve a vital industry in California that include some of the most efficient dairy producers in the world, and they have probably the lowest carbon footprint in the world in terms of dairy products. This created jobs in the community, full-time jobs not only for the construction but long-term operation of these projects, which supports local community. And we're dependent upon a lot of seasonal agricultural work and all that. So good high-paying year-round jobs are vital to our community. Other end is it helped to improve the air quality in a basin that has some of the worst air quality in the world. I happen to live in that air basin, so a little bit on my own would like to help that out. And then the projects were economically viable and provided additional revenue stream to the dairies that had lots of volatility and increased cost of production over the previous decade. So I say it was kind of a win-win-win deal for everybody. In regards to the air quality, the projects provided a two-pronged approach to improve air quality. One, they not only captured the methane that was being emitted, but is expected that the conversion of diesel trucks to RNG, which have less emissions, would help to improve air quality in the San Joaquin Valley. In terms of financing complexity, I really didn't know what I didn't know until I was in. At the end, it's pretty high risk. As we talked about earlier, is a little bit what I call now venture capital at conventional rates. It's because it was a startup with no real track record. Challenges, the complex ownership, 50 individual sites, 50-something entities, 47 digesters, 6 central upgrading facilities, hundreds of miles of pipeline that require, perfected easements, long-term leases, hundreds of agreements between landowners, and the construction project. So, I spent a tremendous amount of time working with lawyers, real estate work, prelims, title company, all that type of stuff. Construction risk, I didn't realize, we had the benefit of, some high, very strong contractors. They're well capitalized. They kind of carried some of the projects for a little bit. And a couple times offered, they were going to walk off the job because we were behind on getting the financing done. But, through communication, we kind of made it from point A to point B. And really, bankers rely upon cash flow as a primary repayment, and collateral as a secondary repayment source, which the projections are solid on this. At the end of the day, farm credit, we like to have collateral. We like dirt and real estate. Here, these are leasehold improvements, and at the end, what's retrievable, my collateral consists of a covered pit full of manure. So, we were kind of really betting on the come on cash flow and that these projects are viable. The results, the project all came online from the summer of 2020 through the spring of 2024. This is a full-time job monitoring construction and getting all the agreements in place. And all projects are operating, meeting, or exceeding, projections. At the same time, I'm still a dairy lender loaning to other customers, so, it was kind of a little bit overbearing there for 5 years. That's why I had jet black hair when this all started, and now it's slightly grayed at this point. The projects include about 170,000 milk cow equivalents. Smallest dairy is about 1,000 cows, to the largest over 5,000 cows, an average of 3,000 cows. Most of them are modern dairy, freestall construction. The economies of scale really don't support anything under 1,000 cows, which for some, that's a pretty large dairy. The average size in Tulare County is probably 1,500 cows now. And freestall dairies are more economical than open lot dairies as far as, the gathering and collection of manure. But these projects, I'd say, from a SWAG, which is scientific wild ass gas, for which, I figure we capture about 750,000 metric tons of CHGs, annually. And this is all done voluntary by the farm credit system and buying into these projects. A few stats, 2019 versus today. A lot of this was based upon, low carbon fuel standards to drive this. 2019, all types of diesel, fossil, bio, renewable, there's 3.8 billion diesel gallons. Today, there's 3.625 billion diesel gallons. But the composition's changed from 79% fossil to 25% to about 25%, with renewable diesel surging from 16% to 67%. Diesel overall decreased 5% in the state. Gasoline in 2019, 13.7 billion gallons. Today, 12 billion gallons, a 12.5% decrease. 2019, electric, 123 million gasoline gallon equivalents. Today, 326 million gasoline gallon equivalents, 165% increase. CNG and RNG, in 2019, CNG was about 180 million diesel gallon equivalents. That was 0.9% of the fuel utilized in California, not counting electric. 77% was bio or renewable, with livestock less than 7%, and the majority coming from renewable landfill gas. 2024, we're up to 221 million gallons, diesel gallon equivalent. We're 1.26% of the fuel utilized, a little bit of growth. Some of that's to the overall shrinking use of fuel, but also some gain that we've increased 41 million diesel gallon equivalents, which was an increase of 23%. Sounds like a lot, but when you only have 1%, it's not that huge. But now, as of fourth quarter, 99% of the fuel, CNG in California, is renewable. 85% of that is livestock for the fourth quarter. And I project by second quarter of 2025, here in a month, I think by when the stats come out that we'll probably be close to 100% dairy and swine gas. So that market is saturated at this point. Back to 2019, when we kind of bought into these projects, RNG value per MMBTU with $3 gas, $220 LCFS credit from California, a $250 D3 RIN credit from the federal program. An MMBTU is worth $112. That's based upon a negative 300 CI score. 2025 value, same $3 gas, $50 LCFS credit as of yesterday, $2.50 D3 RINs. We're now at $56 for an MMBTU. So that's a 50% drop, and the LCFS credit has dropped by over 75%. So so the low carbon fuel standard has done a great job. You can see reducing fossil fuels. Industry responded to that, and now the credit bank is growing. CARB's working to increase the goal from a 20% reduction to by 2030 to 30% by 2030 to increase demand for the credits. It should note that the increased price of credits doesn't help if there's not more RNG tanks to fill in California. So we need to create some more demand. Going forward, RNG has gone from a high value novelty crop, in my mind, to a commodity very quickly. It's gone from very profitable to a market where the least cost producer is probably going to be the long-term survivor. We look at these projects for direct variable costs, $15 to $20 an MMBTU. There's lots of electrical use through compressors and other gathering. CapEx, probably $20 an MMBTU. So national costs, we're seeing $30 to $45 break even. Compared to fossil gas, $3 to $5. So we're looking 10 to 15 times fossil fuel costs. I think California, may be biased. California covered lagoon style digesters are probably the least cost producer due to lower CapEx. In construction, we have mild winters here, so we don't require any heat to keep the digesters going in the winter. In addition, we have the shortest transportation to the market because we're here in California. 5 years ago, like I said, $110 to distribute between the dairyman for manure supply, the developer, operator, and the dispenser. Today, that's cut in half. CapEx has increased tremendously over the last 5 years. Higher cost of operations through costs, and then also cost of capital has gone up 5%. So it's not quite as lucrative today and significantly less returns. In summary, ultimately for the digesters to continue to be economically viable, and get more investment, the industry is going to need to increase demand for RNG. For the transportation sector, that will require the transition of additional vehicles from diesel to gasoline to RNG, which has been slow as discussed. And California can't do it alone. Other alternative options are to use aviation fuel, electricity production. We need to have a conversion from fossil fuels, which are cheap in comparison. So anyway, thank you, and that's kind of my overview of where we're at over the last 5 years for methane digesters.